Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Oh, you know what? We should totally start the music, huh? There we go. So today, CPI, pretty big number, especially considering all of the activity and action that we saw yesterday off of the PPI. Let's go to the charts really quick. Give you a little bit of color here. 10-year Treasury, here's the big spike right here from the PPI. But you can see here in the overnight that we have actually kind of backed off a little bit, and we are closer to the highs of the PPI after there being so much selling during the PPI. S&P 500 a little bit range bound yesterday, pretty messy over there. Oil still holding those recent gains. I think the only relevant thing going on there is that Gaza peace talks are still ongoing, and it really sounds like that they're going to get something this time, although there are still troubles remain. Gold and silver. Okay, well, gold and silver are on the upside again this morning, trying to regain those highs that they had a little bit earlier in the week. Copper trudging along here. Japanese yen a little bit stronger today off of comments from the Japanese central bank governor. I'm talking about continuing to raise rates, I believe. Yeah, and the dollar a little bit weaker here as well. So perhaps the movement of the treasuries has more to do with the currencies, the Japanese yen seeing strength more than it does inflation expectations. Okay. Bitcoin here. Bitcoin, well, they recovered that 90K, but it hasn't done a whole lot from there. So we'll see what the next move is. That is essentially where we're at here going into this CPI news. Let's make sure I have the news squawk turned on and everything. For the US CPI, month over month, they are expecting a reading of spot 4 versus a previous reading of spot 3, which is hot. That includes the cost of energy, though. I'm going to come over here. That includes the cost of energy, and we have seen that oil has taken a pretty measurable move up, so that's why you can get a 0.4. If we were to get a headline number higher than 0.4, that would be pretty devastating. Might still be 0.3 though. I don't know. You know, other components might kind of like even things out. For core CPI, they're looking for a reading of spot 3 versus the expected spot 3. Now remember, yesterday PPI, it was a little bit light. And that's the case here where I think that the market could really move if we got a spot 2 in core CPI. I think that the markets could react very strongly. Because there are a lot of people with hedges regarding inflation. And if we get a higher than expected CPI, you know, if we get a spot 4, then that confirms their fears. And I think that the market will really start to consolidate in the direction that we've been going. Versus if we get a low reading, if we get a spot 2, then that really means the opposite, and possibly even like again, you could be seeing deflation. I see some things in the labor market, like the job market is not hot right now despite the low unemployment rate. Kind of feels to me that what happened was there was the election, there was a little burst of hiring, but it was kind of tepid. People like hiring for some jobs and stuff that they really needed, but they aren't like, you know, okay, let's grow, we feel confident, yada yada yada. kind of seems now in January, I haven't seen as much activity as I was expecting. They might be waiting for the first week or month of Donald Trump's term before things kind of open up. And so if that's the case, does that affect inflation? Well, it's kind of iffy, but you know, that's the kind of the place that we're going. But the most recent producer price index or price indexes, let's say, not PPI, but like PMI, purchasing manager indexes and stuff, have kind of suggested that hotter prices. So it's probably a little bit more likely that we get a number that's hot rather than that we get a number that's light. If we get a number that's light, I think you get to see a pretty extreme reaction. But I also think, you know, if the numbers are in line, you'll probably still see a lot of action. Okay, you'll probably still see a significant move up if the numbers are in line. Okay. Either way, it's probably going to move big. You can see here they are pulling the liquidity earlier than usual for this event. So that's where we're at. Let me blow my nose here. Trying to keep myself dry today. I don't know if it's maybe it's because I haven't been working out in the week as much because I'm often watching the kids during that time, but I've just been sweating super crazy during these streams. It's not like it's hot in this room or anything either, so. All right. It's all acting like they're ready to go, and I'm like, oh wait, we still got like a minute left. There's a little bit of buying there ahead of the news, though. Nothing too big, but good grief. All right, here's a 10-second warning. Ooh, big move up, big move up. It's spot 2. Core CPI is spot 2. Okay, so the treasuries are all moving up. S&P 500 is moving up. The dollar is getting absolutely savaged. So again, remember I said a spot 2 would probably get a pretty significant impulse higher. Let's come back to our volume profile 30-minute chart just to kind of compare. So the top end of the move from non-farms is 01. You're getting a decent amount of distribution here around 27. It's kind of curious that I ended up choosing that price. Seems pretty classic. Okay. That's a little bit better. Well, while that's kind of working its way out, perhaps we should go read the report, huh? Consumer Price Index for all urban consumers increased spot 4% on a seasonally adjusted basis in December after rising spot 3 in December. The U.S. Bureau of Labor Statistics reported today over the last 12 months, the all items index increased 2.9% before seasonal adjustment. The index for energy rose 2.6% in December, accounting for over 40% of the monthly all items increase. The gasoline index increased 4.4% over the month. The index for food also increased in December, rising spot 3%, as both the index for food at home and the index for food away from home increased spot 3% each. The index for all items, less food and energy, rose spot 2% in December after increasing spot 3% in each of the previous 4 months. Indexes that increased in December include shelter, airline fares, used cars and trucks, new vehicles, motor vehicle insurance, and medical care. The indexes for personal care, communication, and alcoholic beverages were among the few major indexes that decreased over the month. So most things increasing, but not as much as they were before. The all items index rose 2.9% for the 12 months ending December after rising 2.7% over the 12 months ending November. All the items less food and energy index rose 3.2% over the last 12 months. The energy index decreased spot 5% for the 12 months ending December. The food index increased 2.5% over the last year. So here you can see energy's kind of sticking out there. But commodities, less food and energy commodities, only spot 1. So a pretty significant shift there. Medical care staying where it was. Apparel. Very interesting. Very interesting. Let's see here. Do I only have... Oh, that's interesting. I'm wondering if I should have been a little bit more aggressive with my market making there or not. But I wasn't really getting the fills in a situation where I kind of thought I was, or rather should. So I was like, let's just get it down to the one contract and let the one contract run. But if we lost $1,000 yesterday, we really want to make more than $1,000 today, don't we? Yeah, well, okay. Probably too late for that. Just note though, okay, we're coming up to the 108. There's going to be some liquidity there. And then again, it's kind of like from 01 to 05-ish is kind of the area from before Friday's non-farms. So there's still kind of some key levels to retrace here. Seeing a little bit of reloading here at the top though. I don't know. That seems like a bullish sign, but it also seems like it would be a little bit odd for it to. Well, I don't think it would be odd. Like in this situation, this is exactly a kind of situation where it would happen. But for them to not really back off at all and just continue marching through, right? You know, like when you look at the treasury prices right now, we could perhaps split it out into two different components or two major things that people are trading off of. One of them is just anticipation about prices, some concerns that we could see higher prices in the near future, just because of cyclical inflation. And then the other side of it is concern that we could see more inflation because of Donald Trump's policies. And what we're seeing is that cyclical component is coming back out because the numbers were lower than expected. They were spot 2 instead of spot 3, which is the opposite of the way that some people thought that they would go. So those guys are going to get out. But there's still going to be some clingers onto this one that Donald Trump is almost certainly going to create inflation. There's a lot of people trading that one. I personally think that it's too complicated for me to know because there are some parts of Donald Trump's economic plans that are inflationary, but what we've seen in the past is that they counter those with deflationary policies at the same time. So when like more broadly, so here's something that I don't see talked about, but I think is important in this situation, is that in order to really have like overall inflation, you really do kind of need more money and less goods. If the price of one good goes up, that doesn't necessarily create inflation, because what happens is there's only the same amount of money out there. And so that increased cost going to that particular good, it has to come at the expense of other sectors of the economy. So the demand for other goods goes down. So, you kind of have to have this across the board in all goods thing to really see like inflation like we saw before. And that's why when we saw the tariffs before and the trade war before with Donald Trump, we didn't exactly see inflation. Like what you saw in the CPIs and everything was not really even close to what some people in the market seem to be expecting, right? Okay, so that was a little bit more of a pop off there. So this is where kind of why I think that I should be 2 contracts long. I do think that this is one that I kind of want to put the throttle on, but I want to give myself enough contracts that I can kind of play these swings. So it coming back here, that's good. This is where, like I could take a second contract somewhere in here. I'm going to let it give me a little bit more. If this is kind of pullback that I think it is, we have a lot of time to be able to make a decision, right? So don't necessarily need to do anything right away. Well, on the other side, S&P 500 is just absolutely loving this one. I mean, look at her go. Wowee. Where are they on a relative basis? Okay, they're above the falls from the 12th, but there's probably still plenty of, there's this in the equities. They got this whole, and then there's like from December 18th. I don't remember what that one was. But there's lots of levels you could look at over here in the S&P 500. And I wouldn't look at levels like this is a key place where we're going to see support or resistance, or crossing this line means this. Is just reference points. We can kind of look at each kind of move as they go to kind of give us an idea of what kind of a move it is. That's all. But it's not predictive in nature necessarily. It's just kind of like a benchmark. Okay, back to 31, which is still point of control. Amir, good morning. So that pullback there was a pretty significant absorption on the orders coming back there. Amir says, oil market is hot. Oh, yeah. Well, it's hot today. It doesn't actually seem to be reacting to the news so much. But there's a lot going on over there in oil. So, it didn't necessarily extend from yesterday. If we come back over to here, right? It's kind of most at the top end of the past day's range or so. But there does seem to be a lot of activity over there, right? A market maker position. I've got, well, it's, I don't think that it's going to be very useful in this situation. Because it was such a huge move. And you're not really seeing the profit taking and so forth yet. So the buyer's cost basis is all the way back at 19. And the stop out zone is all the way at 27. Right? That says to me that so many people got in. I mean, really, what was it? From 13 or negative 130 to negative 105 at one point. So almost 30,000 contracts impulse in the 10-year treasury. I think that what it's saying is where the market maker position from before this move is at is not really relevant. And another thing, so look at my companion indicator. You know what? I need to, if you have the beta, which I posted over in Discord, then you'll have this. But how many contracts does it say that they actually have long? Well, from before this, 25,000, but then after this, 5,000. So I really don't think that the market makers really have a significant position on yet. I think that we would want to, one thing that I kind of want to that maybe we'll make in the future is a drawing tool so that I can say like right here, let's take this high point right here and say, what if we start at 0 and we start basing the cost basis from there? What do you get? Right? That might be more interesting. Now, from here forward is where maybe the market maker position starts to matter. Do you think that this CPI data can break the dollar uptrend? Okay, well, so let's come back to the chart to kind of reference what you're talking about. Bring that down. Well, let's bring up the 6J and the dollar. So we've had a pretty consistent move up in the dollar, and we've been high in the dollar. Like, remember that historically, anything over 100 is actually really strong for the dollar. Okay, so to be all the way up at almost 110 is really strong. Okay, well, we're definitely getting a short-term pullback in the dollar. Is it actually going to break the uptrend? That I don't think I can say, because I think that the key point here is still, what does Donald Trump's policy itself actually looks like, right? Like, again, there's kind of two major stories going on here. I mean, there's more than that, but the two biggest ones that I think is really dominating everything else is, one, concerns about cyclical inflation accelerating and the Federal Reserve kind of having to back off because of that, and then concerns about Donald Trump's policies being inflationary, and the Federal Reserve kind of trying to anticipate and react to that as well. Okay, so what we just had was that one component we've seen we don't need to worry as much about, because it's actually going the other direction now. We got a spot 2 instead of a spot 3. A spot 2 is kind of like under target. Okay, if you get spot 2% inflation every month for a year, then you get less than 2% inflation rate. Or is that right? No, spot 2, that's 2.4. Why am I skeptical of that? 24. But the difference between spot 2 and spot 3 is big. Okay. But I think that the market is more concerned about Donald Trump, right? So the bigger trade has yet to happen. Next week, it's probably going to be pretty crazy. Because you're going to have this dual thing of Donald Trump taking office, and he's got a ton, and I mean a ton of executive orders ready. Like, I think that they said that they had like 100 executive orders ready to go. You're also going to have the TikTok ban. I know that that's kind of a little bit of a silly thing to think about, but I think that that has a pretty major cultural impact. So there's probably going to be a lot of shuffling around next week. I still kind of think that this is like a game of chicken and that TikTok will sell, but I don't know. Like, the thing is even if TikTok sells, the Chinese are saying you can't have the algorithm. So it won't be the same thing. It won't be the same thing that it was right now. Honestly, it's not the same thing that it was when the pandemic happened either. So whatever. Has something to do with how much money is printed in the year. Okay. Deflaton, hey, how are you? I haven't seen you in a long time. You changed your name to all capitals. What's with that? So, like, at the beginning there, I took 3 contracts, and then I took one off just, like, after 2 ticks because I wasn't really getting the fills. And then another one off at kind of like that high of that range. And I'm kind of thinking that the third one that I added on, that I shouldn't have taken it off, and that I could be taking it off here. Because there does seem to be, like, I'm still seeing buying. So, like, if I come back over here to this chart, you look at the cumulative delta, it's definitely long. When you come and you look at my indicator, so by the way, ahead of the news, the market order imbalance was screaming long. Ain't that interesting? Like, it wasn't just like, oh, we had a good move up overnight. Like, the imbalance was actually quite extreme. Are you more likely to see extremes like that in the overnight session? I kind of wonder. But like, the low here just before the news was still like it coming back to 52. Okay. The imbalance still seems to be very much in favor of the longs. But it does look like that they're kind of having trouble pushing it further, that there's kind of that liquidity hole behind it and all that sort of stuff. So I'm kind of like, I'm kind of tepid about they could extend further, but they might need to take a bit more of a breather before they can do that. Despite them like pushing the high end of the range right there. I do kind of wonder to what extent. So first of all, there was that huge trade yesterday. You seen that puke today? Maybe they've already puked. Are these guys that kind of have this larger short put on Are they gonna ride this out? Or do we get to see a little bit more significant of a pushback off of this CPI report? I wonder. R/day trading, please stop buying trading bots. Seriously, these bots are out of control lately. Subreddits are flooded with useless posts and dumb questions. It's getting ridiculous. Either treat it like a straight up gamble or take the time to actually learn the darn indicators. Is not rocket science and it's way easier than calculus. Stop falling for the BS from bots and AI shills on subreddits. Those tools are not going to make you rich, period. Here's a harsh truth. There's no shortcuts in the game. If you don't know jack about the stock market but still want to invest, stick to companies you know. This guy seems like he doesn't know what's going on, but I think I'm going to like oh man, they're really extending. They are. Okay. I feel like I should kind of I want to post like, oh, you must be new here, because it's always been like that, right? But I think I will type it and then not post. When are you taking profits? I don't know, maybe tomorrow. So I 05 is a spot, right? But 05 is a spot that I kind of thought it would take a little bit longer to get here. Oh, nope, it's right there. It's right there. But this one. If they're going to take another leg up, I could maybe take another smaller trade. Would I have done that if you had not said anything? I don't know. Yeah, that's Sim. I have not taken any live trades since, well, I take that back. I take like one small live trade a month. But I basically haven't been live trading since we got laid off, unfortunately. Not in a position to take risk. Man, I'm finding it awfully frustrating right now. Awfully frustrating right now. There's been some jobs that like you know, they weren't like the ideal positions for me, but it seemed like a good fit, and it got pretty advanced into the process. So like going through all of that and nothing coming from it is a little bit traumatizing, you know? It's like, oh, what did I do wrong and all of these things? I don't know. In this particular instance, I'm kind of like probably better because there's some things I just didn't like. That's tough, especially when you're paying 60. I don't think it's 67, but yeah, it's not cheap. So I've the Speculator Seth YouTube channel business as a whole is doing fine, and we can pay all of our costs and everything. In fact, we've been paying for a video editor even, so we're fine on that front. When unemployment runs out in March, I don't know what I do at that point. I'm trying really hard, man. I'm putting everything that seems reasonable. Every job out there that seems reasonable. I am getting a reasonable amount of interviews and stuff. I would say that for the most part, there hasn't been a good fit. Like, that's the thing that's so maddening about this, is that, you know, I didn't get any kind of the severance, and it's a big, you know, I'm paid pretty high, and I'm being thrown into a difficult market where companies are kind of all thinking that maybe they don't need to invest in talent right now because AI will fill the gap. And, you know, it would take a long time to find a new role at that pay level, even in a good market, you know? To aim for 350 days, no. Like the like part of why I've been doing so well the past year or two is because of trading so small. But whatever. I think when you look at my result, my you know, results, that loss yesterday is gonna hurt because that was at like $1,000, but I really should have pushed this one harder. I'm kind of do wonder on, so this guy's like, are there any profitable discretionary traders? Because to him, it seems like there aren't any. I'm kind of thinking about it, and I'm like, you know, there might actually be less profitable discretionary traders today than there were 5 years ago, simply because more people seem to be going into trading prop funded accounts on futures rather than going into stocks. Might be a possibility. Because it really does seem to me like the day trading community, the culture scene, and the things that they say seem to be more futures based than in the past. Well, so far that exit is looking really good, isn't it? Oh, it says I took it off at 04.5. So I guess it was going a little bit further. What did you do? Oh, I was doing site reliability engineering. Yeah, so this is where, I don't know. So there's so many things. I think one of the biggest frustrations is that you don't get as much information as you would like. Like, you know, okay, so I interviewed for a role. I don't know anything about the other people that interviewed for a role. There was one or two that I was really surprised that I lost. Like, everything seemed really positive. On this latest one, it seems like there's one member of the team that has a hang up on something that is kind of like, and he's kind of weird anyways, so I'm like, I don't know. It would be super vague. I'm interviewing for multiple things, so there's probably like the 3 people that I've been interviewing for, like, if they were watching, they'd be like, is he talking about us? But there was one where they were really, really positive and everything seemed really great, but they passed, and I was like, what? Okay. I guarantee you're not gonna find somebody better for that role than me, but whatever. They're probably looking at the wrong things. I don't know. But again, I don't have enough information to know what's going on, right? But I suspect that one of the things that's going on, I'm doing site reliability engineering. A lot of companies seem to not understand what site reliability engineering actually is, and they think that it's just like a DevOps engineer that knows Kubernetes is what they think that it is. In that kind of an environment, if I'm applying for a job and like a site reliability engineer that got laid off at Google is applying for the role, then the guy from Google is going to get it, right? And big tech laid off a lot of people, so there might be some degree of people. Granted, I have a big bank on my resume, but I don't know if people see that as it is not bigger than having worked at a big tech company, but not everybody in the tech industry will know that. AWS is hiring? Are they really? I hadn't seen that. What are they hiring for? So here's another issue that I'm seeing. Is that I live in Utah. I want to still live in Utah. Like, having to move, buy a new house in another city. What a nightmare. I think that would probably net me, like I would probably lose a lot of money on that. If that's what happened. So it's got to either be in Utah or it's got to be a remote role. Well, it's okay, cool, because was a lot of remote roles, but there's not nearly as many. So any remote role that I'm applying to, there's too many people applying to it. And then actually here in Utah, I'm not seeing a lot of roles posted. Like really only a handful of roles. And if your qualifications don't match the technologies that they've been using specifically, they might, so this whole thing of like getting the fit when there's not that many roles being posted becomes like a huge problem, Okay, but Oceanside Trader asks Cloud, I actually have experience with both. Because last company that, well, not last, but one that I worked for a long time, and then I got, pulled away by another company. They basically had an on-site data center, and we switched over to. Yeah, the Amazon has an office in Lehigh. Well, that's interesting. I haven't seen that pop up. I was seeing there was one. I had it in my list and I hadn't applied for it. I shouldn't admit this one. For Adobe. And I was like, do I really want to work for Adobe? I don't know. But here's another issue. Are you from Utah, Oceanside? Because you mentioning Lehigh kind of makes me think that you must know the area. No, you're not. Oh, okay. Well, so like there's Salt Lake City proper, and then above Salt Lake City there's Davis County, and below Salt Lake City there is Lehigh and Provo. Lehigh is really like part of Provo, okay, but it's kind of an in-between spot. And basically what has happened is it's basically become like a mini Silicon Valley down there in Provo Valley. Like there are tons of like tech startups down there and everything, right? Okay. It's like a 40-minute drive for me though, right? So there's another issue that I'm coming to is like, okay, and if I do find a local role, it's probably 40 minutes away, right? Sucks. But let me see if I can find maybe if I just search for AWS. AWS jobs. I do see a couple of jobs, but they don't seem to be in line with my... They aren't SRE or anything. And they don't say anything about where they are either, just United States. Oh, well, and they're saying that they're remote. They're saying that they're remote. But they're like more security stuff. There's one that's Dallas. Probably why it's not showing up. What's the TAM role? What does TAM stand for? I'm looking here, I see like security engineer. Oh. Well, honestly, that's not one that I've heard before. I don't know, I don't get any results. Oh, no, I need to take out the city on that. Oh, I see. Cloud Technical, but those are all in California. Interesting. They are post. There's a lot of them, though. Not in Utah, but I see. You're pointing it out because they're still remote. I get you. So you know what's something that I hate? I just absolutely despise about LinkedIn, by the way, is that they are giving a oh my gosh, I just totally lost my train of thought because I pulled something up and they're looking at roles and all of this sort of thing. I just, that was like a super hardcore ADHD moment in there. Something about local companies that drives me crazy. I don't remember what it was now. Treasuries do seem to be consolidating a little bit harder at 04, although the point of control has not quite moved up just a little bit more. Just another 500 contracts at 04 and it'll move. Oh yeah, okay, now I remember what I was complaining about. Okay, something that drives me nuts about LinkedIn is that it's using an algorithm to decide which roles to show to you, based on like your resume and the things that you've posted about and all of this sort of stuff. And so if you've already like applied to a lot of major stuff, it's not necessarily showing you the new stuff, you know? Like more broadly, there's this bigger problem for applicants, which is for the last like 10, 20 years, if there was a role and it matched you and you applied for it, there was a really good chance that you were going to get interviewed. And like most of the roles that were posted were, you know, serious, legitimate roles. And now all of a sudden we're in a world where like it seems like that the majority of the roles that are posted out there are they're not actually hiring for, you know? So as an applicant, I have to have some way of filtering and deciding which ones I'm going to like spend more time on. I mean, I can't apply to literally everything, but how do I decide, you know, which ones to focus on? There's no information really there for me to do it. And so what everybody has basically had to do to deal with that is to just apply to like literally everything. And then the companies get flooded by resumes. And then that makes it that much harder for them to do their job. And then they also, because they're getting so many applicants, they change their process and get a lot more stingy about who they hire. So it kind of creates this job market that's really tight artificially. Really frustrating. And so I have to do these things where it's like, okay, only show me the ones that were posted in the past day. Here's one that I don't think I saw. I should probably try to apply for after. Let me come in here. Yeah. Oh, I can do it right now because it's an easy apply. Which also means that probably not. I don't think I've had any role. I don't think I've gotten any interviews off of a LinkedIn Easy Apply. It's all about who you know, maybe. I had one role where it seemed like it was a good fit for me, and I knew like the CTO of the company, and he submitted my resume as a referral, and heard nothing from them. I was like, "Are you kidding me? Are you kidding me?" That's like, how is that one? How did that not work? Maybe I applied too late. Like maybe it came in and they had already basically been interviewing and picked somebody. I don't know. That didn't work. Be an illegal. There does seem to me to be a like companies are very much. And I'm not even sure if it's necessarily like companies as much as it is like recruiters are really trying to like drive down, get people for cheap. Like I've had places where at least two where I went to the screener interview, and like their top amount that they were willing to pay was literally 50% below the running market rate, and I'm like, I don't think that you're gonna get anybody to do this role for basically the same pay that kids coming out of school are given. So no thanks. But I've had two like that, and I've kind of seen this thing overall. It's like they seem to notice that there are people desperate enough. I don't think that it's going to be good for them in the long run, but. You got me looking over here. Oh, there's another one posted by NVIDIA. That's kind of weird. Man, this thing is not really backing off. I think I got out too early. Not seeing the continued move in cumulative delta. I am seeing the Japanese yen continuing through. Yen pairs are your go-to. Yeah, there's lots of activity overnight. Yeah, I'm just kind of noting, you know, hey, it's not stopping. This kind of has signs of trend day written on it, and we got out in an okay spot. Like, it did come back, but it did not stay there for very long. So the issue that I have, and the thing that I was thinking about when I was taking that out, is that my MFE is substantially more. My average MFE is substantially more than my average take profit, which means I'm letting trades come back on me too much. I'm not getting very good exits. So when I get that kind of sign of like distribution at the top that's likely to come back a little bit and everything, I've been taking them. And in this case, you know, I could have held out for more. It's only like 4 ticks and all, but still trying to optimize as much as possible. Here's a situation where discretionarily we have reason to believe that it could go all day. Although, interestingly enough, it has subsided on the delta side. So.
Block sell.
That was a little bit more significant of a pushback, though. Whoa, what? Come on. I thought so. I just took a one ticker there. That was a big, dude, that was nutso. So there was a relatively major sell there. And then the buyers came back with vengeance. I mean, they really hit back at that. I saw the iceberg at 08. That was a huge iceberg, by the way. So I decided to take a fill on it and just take one tick. And probably should have gone for more than one tick, because then you got the impulse that broke the high again. Palestinian official says Hamas gave verbal approval to Gaza deal, waiting for more information to give final written agreement. That could be the market reacting to that. And then somebody saying, oh, that's a sell, and everybody else going, no, 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 that's a buy. I don't know. Sam Altman, Mark Zuckerberg, and business leaders choose Trump inauguration over the World Economic Forum in Davos, Switzerland, per NYP. Elon Musk posting video games are meant for you to be immersed in an exciting and creative alternative reality and have fun with friends. Adding present day political BS kills the vibe. I kind of wonder here if Mark Zuckerberg in particular, because what he seems to be saying is, I've been kind of more leaning Republican for a long time, but I had to, you know, play along with the Democrats because otherwise they were going to hurt my business, is what he's saying. And I believe him, actually. I believe him. It just, everything that he's done and said over the years seems like it matches more Republican than anything else. And that's kind of a big shift. Or that is not a shift, but like the reality was always this underlying reality. It's just that we as people didn't realize it. That a lot of these companies were being led by kind of more Republican political leaders. And that there is a stronger component of tech broism in the Republican Party than people realize. Because I'm not a fan of tech broism, right? I found was taking profit after overextended moves, re-entering of the pullback of those moves is more profitable than scaling out or trailing with a stop. Yeah, well, I'm taking exits based on like large orders, essentially. Is like I want to be in before the move. And then when I see like the big move is happening and there's lots of volume happening with the big move, that's when I tend to get out. Now this last push even further, that this looks like something different. Like there was an insane impulse there, so. You know, one of the things that I find really frustrating is that it seems like that, like, trailing the stop should be an effective way to trade a move like this, but then when I backtest that sort of a thing, it does not work. Right? When I look at exits, I have not really found anything that really objectively gives you better exits. Like, more broadly, the thing that I seem to find in my back testing is that volatility tends to dominate overall and makes it very difficult to make money on a directional move. And so anything that you do about like my stops and targets and all of those sorts of things on outright position don't really help you, because the real problem is the outright position, that you're taking something where you enter in one position in one instrument and you hold it until you decide to get out and all of that. Is there some property of the market that can tell us when it's better to get in and when it's better to get out? And I'm not sure that there is on the get out. On the get in can be, you know that there's volume coming because of news or whatever the deal is, right? But the exit doesn't. If you're using some ATR based trail or any other standard trail, it's ineffective. Yeah, exactly. Now, strategically, trails stop. When certain qualifications are met, I move the stop up. Perhaps. So, like, there's this other thing. So like, here's something that I think would be relevant there. Is like, can you find a signal? Okay, when you see this particular thing, and you enter into the position, and you stay in the position for a set amount of time. Let's say it's 5 bars, maybe it's 20 bars, maybe it's an hour. But that's the average maximum adverse excursion for how many ticks it goes against you in that trade is less than it would be with a random trade. So you have some sort of random benchmark, which we have. We have one where it's randomly selects a time and then stays in it for 5 minutes, right? So that should give you a good idea of like what the volatility is. Is there some sort of a signal that gives me a better entry, that I have less adverse excursion against me? Haven't been able to find that. I do kind of think that order flow signals should give that to you, but we don't have enough data to test that yet. Coming out of Bloomberg right now, Russia will demand Ukraine drastically cut back military ties with NATO alliance and become a neutral state in any talks with incoming U.S. President Donald Trump. Treasuries do seem to have settled down quite a bit after that huge impulse. That really was a wild impulse, wasn't it? Can you believe it's only been an hour? Oh, man. I don't understand how you could ever find that, given the market isn't static, nor does it move in a predictive, orderly flow. So if you can't ever find a signal where your MAE is less than average, doesn't that kind of suggest that you should just never outright trade or scalp? You know, like, if that's the case and your results are always just going to be kind of like based on the volatility at the time, then shouldn't you just trade options? Shouldn't you just market make options? You know? But I can say in some instances, like, okay, if there's a piece of news, right? And I really know which direction the news is going to go, I can take a trade and I'm not going to have very much excursion against me. But how do you test that? Right? That's way too discretionary for us to programatize with the skills that I have, at least. Disagree. Well, no, it's not a probability though. It's an average. Like a probability would be like I enter based on a signal and I hold it for 5 minutes, and after 10,000 trades, I am profitable 52% of the time or something like that, right? That's also one that like unlikely to happen for you. That's the one where if you're only using a price data series, you're probably not going to find that. Well, the MAE, I don't think that you're probably going to find that with just price either. But when you add a bunch of other things together, other data series besides price, other instruments, sentiment, news, every piece of data that you can find and incorporate, I do think that you should be able to find, setups that have positive expectancies or whatever you want, however you want to put it, right? But I don't understand your fixation with holding a trade for a predetermined time. Well, because that's a way that you can. Okay, well, let me explain. So there's something in statistics that they call IID. So you want to have factors that are independent, essentially. What's the word that they use? Independent and identically distributed random variables. Okay, so that means that the thing that I am using to so if I'm going to do a test, right, and I want to test my entries, then I need my exits to be essentially random if I'm going to just test the entry, right? So how do I do that? I need to have some variable that I'm using to determine when I get out that is independent and identically distributed. And there might be a better option, but I would say that probably your best option is time. Hold it for a certain number of bars. Right? The reason why you want to have a setup like this is because when you're going into machine learning and you're doing optimization runs and all of these sorts of things, there's a lot of problems with like overfitting and stuff like that. So, if I come in and I say, okay, here's my variables and what's the best period to use? And let's use the period that gives me the best profit, right? Well, then what it's going to do is it's going to optimize towards either the strategy that trades the most or the strategy that trades the least, essentially. And you're not actually finding a value that's maybe actually best for your strategy, right? Like you're running a test on this one thing. I want to find an optimal value for this, and then maybe I'm going to use that value for other tests further on. Well, because you're overfitting in that phase, everything you do after that kind of ends up being pointless anyways. So what do you have to do? You have to run those tests in kind of like isolating parts. So I'm going to focus just on the entry. Do I have an entry that when I make the exit random, that I have some sort of probability of winning, or I've minimized the MAE in some way, or I've maximized the MFE in some way, right? And those are kind of variables and so forth that will tend to get you better results, right? Now that you know what kind of an edge there is in your entry setup, then you can go and start investigating what is the best way for me to exit on this particular thing, right? Now I feel like I'm really confident on my entry, and I have all this data to back up my entry. Now we can do tests and see like what works best on getting out. Right? But when you do something where here's this one type of entry and there's this one type of exit, and you're doing all of that stuff right from the very beginning, you run into all of these sorts of issues where it's like, well, but you're trying to find an optimal system, and you're trying to see, because there's this issue which is like, does it work? And then what are the optimal properties for it if it does work? And is trying to find optimal properties for it overfitting the model and creating something that you think works, but it doesn't because it's just overfit, right? and that's why I've kind of learned to split them out. Because when you just set this whole thing up and you have this whole idea, especially because I think the typical retail trader's approach to this is going to be, I was told that RSI is a good indicator and that I should buy it when it's below 20 and sell it when it's above 80. And so I'm going to go and I'm going to program that, and ta-da, and that should be the strategy. And that never works. Anything that you ever read online that is that specific, you're going to go and program it up, and you're going to find that it doesn't work. So you're going to have to find something that's unique, that's not really out there and everything. So you kind of have to like build your own strategy. And that's kind of how I found you have to do it. So you don't go in with this huge setup preconceived notion about how it's going to work. Instead, what you do is you set up very narrow specific tests looking for particular inefficiencies in the market, something that I can prove about the market. Hey, when this thing happens, it tends to go more in your favor than it goes against you, essentially. And that gives you a much better chance. That helps you avoid all of these pitfalls with overfitting models and all that sort of thing. So after you run it, how much effort do you put into going back and studying the reasons of the failed trades? So most of the time when you get a failed test, the reason that you get a failed test is just because the market is random, right? So like I can go into each individual trades and I can try and say, well, I think that this trade failed because of X, and I think that this, but we're talking about like a million trades. You know, like, so one of the things that I've done is I've been like, okay, so we have a certain number of trades, and maybe there's something about the market conditions that makes this work well or not work well, right? Trend is probably the big one, right? Maybe this strategy doesn't work very well when we're in a trending market, and it doesn't, it works well in trend and doesn't work well in range bound market or something like that, right? Well, that's when you do things like I was kind of doing the other day where, there might be a particular metric, and for every trade that I take, at the time that I take the trade, I print out the metric, and then I go and I do a statistical analysis of that metric. I can look at the distribution of that metric and say, okay, is there actually an association between this metric and my trade succeeding or failing? Okay, then I can go in and add it in and yada, yada, yada. But when you're talking about thousands of trades and distributions and everything, right, you kind of have to have a systemized approach to it, right? You can't just go and look at one trade and say, well, I think that this one failed because of X reason. Blah, blah, blah. Especially since here's the other issue is that like discretionarily, you might sit down and say, well, this one didn't work, obviously, because it was trying to go short on a day when the CPI was a huge miss, right? Like, yeah, of course, you want to only take longs. Well, but you only know that because of information that your algorithm, that you don't, a data series that you have that you can't really give to your algorithm, right? Unless you have some way of reading the news, determining whether that should be a long or a short, and giving that information to the algorithm as well. Right? And then you run into all of these issues, which again, it's like, that's just another variable in it, right? Another variable, another complexity to the strategy that can result in overfitting. But what I do, but again, going back to like you do these narrow tests, right? Well, what do the narrow tests say? Market's pretty efficient. Market's pretty statistically efficient, at least. It's not informationally efficient, but it's very statistically efficient. And maybe part of the reason why it's so statistically efficient is because it's so informationally inefficient, right? I don't think that given the tools that like come with the platform, that you're probably going to really actually find something that's actually really works. Because there is not enough edge in a single time price series to actually work something. There's too much noise. There's too many other things going on to be able to separate them all out. You need additional data series to work that out. And some of those data series are things that we don't really have a clean way. It's not just another chart that you can add on there. Some of them are like related assets are, but some of them are things that, some of them are things where the data isn't completely available to us. Like I might be able to read an analyst's report and know what the state of that thing is, but I don't have a data series I can pass into my algorithm. Or some of it is based on like, I know the structure of the market, like the market microstructure, and here's this thing that changed, and here's ergo how it should play it. Like, how do you program every single one of those possibilities into an algorithm? Like you can't, right? This is my point is a trader's discretion might only need to eliminate a small percentage of losing trades to turn that losing test into a profitable one. Well, yeah, but you're thinking from the perspective of like, if there's 50 trades and it's a 2% edge, then all I actually need to do is to change like 4 trades into winners and that's all good, right? But that's because that's not enough data, right? You probably need 100 times that much data. So now we're looking at 10,000 trades, and that 2% difference ends up being like 200 trades. And maybe even that's not enough, right? And how do you look at 200 trades that you're going to be able to turn into a winner or a loser? Well, you don't have the ability to go down through all 200 and, see what should have been done on those. And probably the chances is that well, you're not looking at 200. You're just trying to change 200. You're actually looking at 5,000 trades, right? You definitely don't have the ability to look through 5,000 trades. And so you have to find some sort of a backtestable, systematized way of saying, okay, let's try this thing, and does that change 200 of the losers into winners? Right? And what you're going to find overall is like you're going to add this additional filter onto it. And like there are some that were winners there were some that were losers before that they're winners now. But there are also some that were really big winners that we got out of before that, or we took the loss on them. And so it all evens out and it doesn't help you, right? But you see, all of these problems are really problems related to that. What causes the market to actually move? It's the orders. It's the orders coming in. The interaction of the market orders and the limit orders determines how price moves. In order to predict on a short time frame where the market's going to move, you have to be able to predict the future orders. And the future orders are not really very correlated to the past price. It's not. So it doesn't really matter which way you kind of finagle things around with your indicator soup on price, because the price in and of itself doesn't contain a whole lot of alpha, a whole lot of edge in predicting what the future orders are going to be. The order flow has some alpha, but those are kind of limited in nature or very short term, right? So we have to have something that actually predicts the future orders, and that's where the things that I know of that actually predict future orders are things that I can't attach a data series to. But I can know what direction is going to be, and that there are ways for me to do data science and research and so forth to determine how that's going to affect future order. Yeah. Well, there's your problem right there, illegal immigrant. I wouldn't backtest 5,000 trades unless I was planning on placing 10 trades a day. In most cases, well, so it wouldn't be 10 trades a day. You would need like 5 years of data, or maybe even 10 years of data, depending on how often it trades, right? Because the issue there is if it's only 200 trades, okay, or let's say that it's only 100 trades to make the math easier. If it's 100 trades and the edge in the thing is 2%, that means that your profit only comes from basically 2 to 4 trades, right? Well, like that's like within the margin of error. It's within the margin of error. So you can't go in and say, oh, I took 100 trades and there was, 2 more winners than losers. Ergo, this strategy is profitable. Like, what do you really think that the chances are of that result carrying forward? It's not very high. You just don't have enough data to confirm a statistically significant result. And the biggest issue here is that the market has fat tails. So there could be certain situations where your algorithm will just do absolutely terrible and wipe out all of your profits. And you're not going to see that until you have enough samples in there, because those outliers by their very nature are more rare, and you might only see one of them in 1,000. So if you're only testing 100, you're not going to see it, right? That's why you have to have like these insane numbers of trades for like a really good quantitative analysis here. You wouldn't go to I'm telling you, you don't go to you don't go over to Jane Street and show them results in a spreadsheet of 100 trades and then go and make that the new key algorithm for them, right? They have way more data than that. Okay, it makes no sense to test past year's data because you're not accounting for market changes. Any code that should be tweaked periodically, why run a 5-year test with a code that will be tweaked? Well, so first of all, you're stating something that it's not going to be applicable in all markets, right? So why would that be? There are some legitimate reasons for that, right? The '08 iceberg is turning out to be a giant. Yeah, it is. It really is. It might be the case that the guys that were looking to buy that like they kind of use that as an opportunity to like get the rest of it out in their system, and now the buying from here will be substantially more measured. So like if I want to sit down and I want to say, people have a tendency to do this, or the market has a tendency to do this, shouldn't that be something that's consistent from year to year? If it's not something that's consistent year to year, then like that's a whole other set of problems, right? I wouldn't run the same bot in every asset on any time frame. I think that the algorithms that are going to be the best ones that you do. Well, and not time frame. Time frame has nothing to do. Time frame is a completely different issue. But yeah, like if I'm running a market making robot, you know, there are certain properties about the market that I want to utilize, that I'm trying to utilize them in every market, because, you know, especially the things that are a result of the limit order book, right? Okay, because if you were to say, okay, the market changes every year, so running this algorithm on this year's data is legit, but it shouldn't work on last year's data. Okay. Then you basically created a situation where you're never going to be able to collect enough data to find a statistically significant result. And you're basically trading blind at that point. Right? Like, assuming everything that we said there is true, then what information would you have that would suggest to you that your algorithm is going to work, right? If I can go and I can backtest it on 5 years of data, and I can find that the performance of that is pretty consistent throughout that 5-year time period, then that's a really good reason for me to think that it's going to continue to work, right? But if I can't do that, I can only do it on a year's worth of data, then what? And I can only do it on like 100 or 200 trades or something like that, then why would you ever think that it's going to get, that there's actually an edge in there? Because you're never going to have a statistically significant result. You would always basically have to just play blind. You're getting focused. I think you're kind of missing my point here, because you're bringing up something that's not relevant to the point, right? The point is that you need a lot of data to prove something in markets. You need a lot of data to prove things in markets. So if the period of time in which a backtest is valid is that limited, you can never prove anything with statistical significance. And then you're going to say, well, it changes from year to year. And how are you going to know the way in which it changes? Okay, well, we could do a forward test, right? What we can do is we can say, here's the market. We're going to look at the market over this 1 month time period, and we're going to see how it behaves. And then we're going to trade with that for 6 months or however long you want to. And then, you know, constantly have this retesting time and adjust the algorithm as it does. You can do that. And then you could find that, like, okay, yeah, like the market changes, but I can adjust with that change. Then you would prove something. Well, yes, you do not believe that the years of data is needed because you don't know what you're talking about. To be quite frank with you. Listen, I am not the one that come up with this stuff. Okay. I think that like my natural approach to this would have been like, run it over a months of data and it took 20 trades and it was a winner. That's it. We should go with that. That's like, I think that that's like the natural person, right? Okay. But I have all this research. Go and read Nassim's books. Okay. You need more data than that. You need more data than that. You go into a quant shop and tell them that, they will laugh at you. I know that because when these quant shops are browsing Reddit and they see these people posting these results where there's only 1 year of data in the backtest that they have, they're laughing at them. No, I don't think that Jim Simmons would agree with you. The guys at Renaissance, you don't understand, man. The guys at Renaissance literally spent like 10 years just building the data infrastructure so that they could keep track of all of the data and information that they needed to be able to develop the algorithms and create the edge that they did. They did not just come in and everybody in the retail world has this bizarre idea that like Jim Simmons just came in with a 1 minute chart and analyzed it and then that was it. No, that's not what they did, man. The amount of data that a platform like Renaissance Technology deals with is insane. You're talking about something that takes thousands of people to maintain just the data infrastructure, just the data. And why is that? Because they're running things on like literally 30 years of data. And not just 30 years of data, but like 30 years of possibly order flow data from multiple instruments and putting them all together. Like, it's absolutely insane. It's absolutely insane. I mean, he has said to this, there is this point where they discuss like, okay, like most of the time, not most of the time, but usually, I said usually, that's still most of the time. There's a good portion of the time where you have reason to believe that a particular strategy is going to work because of the structure of the market, and you do not have enough data to prove it. You use the data that you have, but you usually come back and you're like, I wish I had more data than I do. Do not think that I'm no offense, illegal immigrant, but you're saying like a lot of, you see, this is where my ADHD thing comes into, like when I'm dealing with
Block
people,
by
is like, I'm sure that there's probably this diplomatic way to say it and deal with it and everything, but that's just not the way that I work, man. All I can tell you is the truth. You're saying like low IQ things to me. I just gave you an explanation, the statistics and like the reality that there are at the firms and things like that. And you're ignoring everything that I said and going back to an earlier point that I've already addressed. I already addressed, like, okay, if it needs to be tweaked, what makes you think that you're going to be able to effectively tweak it and keep up with it? How do you differentiate between it needs to be tweaked and it just doesn't actually work and you just happen to find a time period where it randomly worked, but there's really nothing to it? How do you differentiate between those two? There's ways of testing it, man. There you go. Big sample of data forward testing is vital, I think, in quant trading. Then the system is not static, but dynamically adjusted, but the basis is still the same. I think so. No, in your mind, you address, yes. Okay, so let me explain to you the way that, like, debate, I guess, because we're having a debate now at this point, right? Let me explain to you the way that debate works. You make a point. I make a counterpoint to that point that addresses that point. And then you will give me points or reasons why the logic that I just gave you is maybe not correct. Okay? You don't just go back to your point and restate your original point. Because you didn't think that you proved it, right? Okay, cool. You don't agree with me, but what is some logic and reason as to why you don't agree with me? You're not addressing my point at all, right? You're like ChatGPTing it. You're just restating what you said earlier. I already explained to you why you're wrong. You're gonna say why I believe you're wrong, but no, I mean I believe I'm just gonna say it. I already explained to you why you're wrong, and none of what you're saying is addressing what I said about why you're wrong. But Arundel is correct. Like, yeah, systems need to be adjusted, but there's ways of showing, you know, the way that I adjusted and everything to give you guidance on how to do that. That's where forward testing. So you have you test it against a certain time. You have like basically you have a fit period and a test period. So I look against a certain period of data and I say, okay, how should I be doing this thing? And then I run the results of that against this test period. And if it still performs in that test period, then it's like good. And if it's like it's only going to be valid for a certain amount of time, then I can redo that process every 3 months or every year or however often you need to do it, right? Yeah, it's indisputable that the algorithms change, sure, but that does not support your argument that an algorithm, you don't need to test it on more than a year's worth of data. I mean, like, part of the reason why they tweak their algos regularly is because they're constantly finding more information to make them better. Not necessarily because... So there used to be this whole section of the quant industry where they had what we call generational algorithms, and these things would go through and they would know about like every technical indicator and so forth that you could possibly think of, and then they would have these programs that would randomly combine these things together and test it. And so this thing was literally running like billions of tests every night about what was the best way to do things, right? And then they would find that like whatever was the best thing that worked kind of shifted around. So then they kind of shifted over into trying to predict what was the thing that was going to work that next day. And then the 2018 quant crash happened. And all of those firms basically blew up. because the reality is that they were all just actually overfitting. And once a time period with a large enough volatility came along, all of those robots failed. And those quant firms went under. No. So here's what you would do is like, okay, so I've made my algorithm better. What am I going to do? I'm going to test and see how it would have worked over the last 10 years. Okay, if there's some sort of variable in there that changes over time, then I'm going to program in that variable that it changes over time. Like, what you're saying kind of doesn't even make any sense. Like, if it changes over time and you can't collect enough data for a statistically significant result, then what is even the point of backtesting it at that point? Doesn't really make sense. what you've done is you've taken something that you heard somebody say without enough background to really understand what they were talking about, and concocted this whole thing that wasn't actually, that's not, is the same thing that everybody does with momentum strategies. They're listening to all these people that are trading momentum strategies, and they go, oh, okay, so this is what I got to do trading. I gotta this, that, and the other, ignore the news, just do what the market's doing. And then not realizing that the key part of all of this is it's trading momentum over a universe of assets with multiple positions at the same time. And your outright trading is completely different. It's not relevant. Yeah, it doesn't make sense to you because you don't know what you're talking about, dude. In order to have a productive discussion here, the first thing that you have to do is acknowledge that I know more about backtesting and quant trading than you do. Okay, like most of the time I wouldn't say something so big and egotistical, but you're just saying so many things that are so obvious that you don't really understand this world very well. And when I'm telling you things about the way that the world kind of works, you're not even incorporating them, because I already explained to you the way that you do that is if I make a change to my system, I go back and I backtest it over 5 years. Does it perform better than the older version of the code? And if there's a property in there that changes, and I don't necessarily know how that changes, I can utilize machine learning and forward testing methods to kind of determine what that property should be, and then see how long that property is going to be valid for, and constantly retest it. But I still am able to create a system that is basically like, okay, I go back 5 years ago and I start trading this system, and I know over the 5 years how I'm going to be able to change those things. I can only use the current data when I change that, so I can only look at, like, the last month or last year or last 5 years or whatever it is going to be to determine what things should be. But like that's how you do backtesting, man. This is just backtesting, right? Man. Obviously you don't. Yeah, I don't work in the quant industry, that's for sure. But I do know a thing or two about it. I do know a thing or two about backtesting. I've probably backtested more strategies than you've ever even conceived of. Okay. And I know a thing or two about the way that these things work. And I can just tell you right straight away. Okay, here's the reason why what you're saying is stupid. I can make almost any system appear profitable over a 1 year time period. It is so easy to overfit something to 1 year. It is so easy. If you can only ever test 1 year of data, you might as well not backtest it. Like, seriously, that's just not enough data to really show that that it's something real. How valid could backtesting using data from conditions which are different to the current conditions be? Well, so this comes back to this thing, which is like, I think that there's another kind of disjoint here, right? Like, if I'm going to say something about the market, okay, like, we've been trending a lot lately, okay? Like, okay. Why is that going to be applicable in the future? Who knows? Past performance is not necessarily indicative of future results, and so now what basically, do you know anything now at that point? No, you don't know anything, right? So what I would really like to see is, oh, I know something about the market, and I know why that thing about the market happens, and because of the nature of that thing is not going to change, and ergo, I have a very good reason to believe that particular strategy is still going to be applicable into the future. Okay, so the empirical properties of order flow that we talk about, these are things that are created by the actual structure of the market. The square root law of meta order impact, that is, that if a large person comes in and trades the market, the impact that they have scales as a square root. So if you trade double the size, it doesn't move the market twice as much. It moves the market 1.4141, blah, 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 blah. The square root of 2, okay? This is caused from the research that we have by the use of a limit order book. So as long as the market is using a limit order book, we should see that behavior exhibited in the markets, right? Now all of a sudden I have something that's like, okay, I can go and I can look at this data about, okay, it follows the square root law. As long as we're using a limit order book, it will continue to follow a square root law into the future. See what I mean? Right? And that's very different from, well, people have a tendency to do the X particular thing. You know, like if it's people are doing this right now, then I have a very, very good reason to think that it's not going to apply into the future. Do you believe that time frames are fractal? So I think that if you were to say, like, what are the relationships between different time frames, it's, you know, I think it's more complicated than that, right? There are some things that you are going to see reflected on different time frames, and there's some things that you're not. So the biggest one that I think you're going to see is that on very short time frames, and I mean like very, very short time frames, markets have, there's a high degree of mean reversion in markets. Like if you're trading on a 1 second chart, like the amount of mean reversion is like really crazy. Whereas when you go out to a daily bars, there's a significantly more amount of trendiness. Generally speaking, time series momentum, a strategy where you're trading a universe of assets based on certain indications, filters, and entry signals about when a market is going to could potentially start trending. Those have been demonstrated quite effectively on daily bars, and I have never seen anything that shows time series momentum on a 1 minute chart, right? So there right away, there's something that we have seen on a difference between what daily bars and 1 minute bars, right? Just what I was talking about, that the impact of a large meta order tends to follow a square root law. That in and of itself kind of creates a difference between your daily charts and your 1 minute charts, because it basically, it's kind of like a cap on how far a market can really move in a day, or can really move at any one time. A limitation that does not exist when you come out to the daily bars. So that's a notable difference. Okay. You know, I think it was kind of funny. I was seeing this discussion where they were saying like, I can pull up a chart and you wouldn't be able to tell me whether it's a 1 minute or 1 day. Well, yeah, if you cherry pick, right? I do this. Let's do this. We'll come over here. We'll come over here to our charts. Don't look. Close your eyes. We're going to use a big black marker here to like cover up what you're looking at. We'll cover up the time frame. Oh, we have to cover up the actual times too. Okay. Super great. Okay, now you can't. So now all of the identifying information has been removed from the chart. What is this? And I'll tell you, it's ZN. Is this a 1 minute chart or a daily chart? Like, obviously, it's a 1 minute chart. Have you ever seen that? Come on, have you ever seen that on a daily chart of ZN, where it goes flat for like 100 bars? No, it doesn't happen. So yes, are there things that where I can identify? Are there instances where I can make a differentiation between a 1 minute chart and a daily chart? Yeah. Okay. These sorts of things don't happen on daily charts in ZN. They just don't. You can see on the chart when the news is that, and if I go large enough, like that's the other thing, is that once I really start incorporating enough stuff, right? Like here's PPI from yesterday, right? Like I can see that at 6:30, so at a regular interval, that there is a potential volatility at that time, right? Like there's all of these sorts of things, right? So yeah, there are things that I can use to identify that it's a 1 minute chart or a daily chart. Like, so there is like some degree of like, what do we call it? That its time frames are fractal. Like it is that way to some degree, but it's not absolute. And more broadly, the reason that matters is because there are many strategies that we know of that work on daily bars, and they don't work on intraday bars. They just don't. Scroll to a piece of the chart where the big candle from the data drop isn't skewing. No. Listen, if you scale this really far down, it just gets worse. Okay. Here's the overnight. Okay. If you pulled up a chart like this, okay, not only am I really certain that it's a 1 or a 5 minute chart, but I'm also really certain that it's CN. Nothing else does this. Right? ZN will literally sit in a 2-tick range for multiple hours. And there is not anything even remotely close to that on a daily bar. Not anything even remotely close to that. I never made that claim. You killed your own claim from 30 minutes ago that your extensively tested bots work equal amongst all ads. I never made that claim. I would never make that claim. I did not. I'm sorry, you maybe have poor listening skills, but I absolutely did not say that. What we can do is we can go back on YouTube and because it's all recorded. We can grab the transcript that YouTube pulls out, and then we can pass the transcript to ChatGPT and ask ChatGPT if I said that. Would that be a fair? Would ChatGPT be a fair? Because I did not say that. If you think that I said that, you misunderstood what I was saying. I'm explicitly telling you there are things that work on a daily bar that don't work on a 1 minute bar. And that's important because more broadly, I don't know of anything that works on a 1 minute bar. Like there's this thing, like if you come back and you say there's a function, I have f of x, where x equals this data series of prices. What are we in the S&P 500? 5,000, 5,000, blah, 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 blah. Okay, all of these data series, right? And X is basically time price series, 1 minute bars. Okay. So maybe f of x is an indicator. Okay. So you might have the S of what should we call it? I don't know. You could have this S of x is equal to, f of x plus g of x. All of these things, right? But the only piece of input that you're putting in is a single 1 minute time price series. I know of no such function that comes out profitable. And in fact, I have a lot of reason to believe that it's not possible. Because there's too much noise on that time frame, and there's too much randomness injected on that time frame for it to work. Now, if I have y, which is equal to a different thing, like maybe y is equal to ZN Treasury, and Z is equal to the dollar index, and O is equal to the order flow signs and all of these things. And I have like 12 different data series in here. Now you got something different because it's not the f of x. No. Now it's the f of x, y, z, PDQ. Blah, 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 blah. Right? Would that yield a profitable strategy? Potentially. Because we do know that if I have daily bars and my f of x, is like this huge universe of assets, that there are profitable strategies, and that's momentum. We know that one works. That's well documented. Right? So there is a specific issue with one data series, and there is a specific issue with intraday data, like 1 minute bars, 1 and 5 minute bars. And, maybe when you get out to like 30 minutes, 60 minute bars, maybe it's different, but. Kind of thinking back on like, okay, so part of me was like, maybe I should just hold it all session. And I'm wondering now, well, I kind of do feel like I should have held it all session. I think if I had not taken a hit yesterday as hard, that maybe I would have held it all session, but I was a little bit worried about how much it might come back on me, How are you? I'm feeling pretty good. Well, actually, I'm doing terrible, dude. Doing terrible. Oh, it's Ali. How are you doing? Dude, I haven't... The video that you sent me... Yeah, me neither. Well, not live trading, at least. I wasn't able to look at the video that you sent me yet, but I'll do that after this, and then if it's good, I'll post it this afternoon. I keep running into these issues where, like, there's lots going on, and I'm not able to post it when I want to, but let's look at it. I'm trying to get a video together here so that we can post this for the end of the month. Or like maybe, oh, well, would it be? No, it would probably the earliest we'd be able to get it is the 27th. But dude, it's been tough finding the time and stuff. And feeling inspired enough. But do you think it can impact my trading? Like in December and January, I can't find any good setups according to my strategy, so I just left it completely. Well, I don't know. That doesn't really sound like any kind of decent strategy that I know of. But like if you're just trading discretionary and you're trading on informational inefficiencies, you know, like I know something that the market doesn't know, or I know hasn't been priced in, and I have some reason to believe that it's going to be priced in shortly. Maybe you're just in a bad period where the information that you have is bad, or you're distracted, so you're not as up on the information as you want to be, and that's going to happen, right? And your results are going to largely reflect how well you understand that market. I'm just kind of thinking here, by the way, with that trade, where do we look at now? Well, they haven't touched this high from last Thursday at 14, but they came awfully close. I'm reading back on the log here. During the discussion of changing market behaviors when you claim that wouldn't affect the performance of your bot, I said nothing about time frame. Said nothing about time frame. More broadly speaking, I never go and take something and say, let's backtest it on 1 minute bars. Okay. Now let's go and try it on 1 day bars. I never do that. Never do that. But in changing market behaviors, we can do things like, okay, a cyclical indicator. Maybe there's a certain part within this cyclical indicator that I want to take a trade on, but that changes, right? So there's just one particular value that I'm trying to optimize. Optimize it over a month, run it for 3 months. Optimize it over a month, run it for 3 months. But I don't, with that sort of a test, shift timeframes. That's a different thing. You misunderstood. The big one that you're going to run into is volatility. Generally, find that if you just tell your algorithm to not trade when volatility gets too high, that it helps the performance of the algorithm. Should I perhaps show you? I don't even know if he's still there, but we kind of have this over here. So, the tilt strategy is probably not a good example because I don't know if there's a really good thing to change. Oh, well, actually, maybe we could. Thinking about taking the hero trade for the landing close? Why would, I mean, at this point, isn't it like a trending day? Like, I don't know if any kind of short makes sense at this point. The reward, I don't think the reward would be high enough in it. Actually, maybe we can do it with this one. Because there is the thresholds and the doji threshold, right? And we were trying to optimize it like going between like 10 and 100 or something like that, right? Let me switch it over to this. Yeah, between 10 and 100 at the doji threshold. Oh, and the direction. And the direction. So maybe we say, well, this changes with the market. We can do walk forward optimization. And then all of these nifty little properties pop up down here to say, optimization period 10, test period 28. So it basically, it tests it over 10 days and then it runs it over 10 days. And then it does that over and over and over again. Right. Well, it's that's going to give us way. That's way too many iterations. Well, actually 29,000, maybe not, because if you're doing, it's basically, it's going to say I'm going to do it over a month. That might be smaller. But it's more because it's basically like 400 each time. Yeah. Can I get it to abort? Abort, abort, abort. Nope, I think I killed Ninja Trader. I don't want to run it right now. I'm probably just going to kill it. Maybe I could run it after, or when I'm not at the computer. But that's how you do those, right? And then I have some property or set of properties that I will try and optimize over. Now, of course, the problem is again, there's like this whole overfitting thing, and but if you're overfitting, then what will happen is it will, the test period results won't be very good, right? So now you have to kind of make things so that the properties that you're changing and the ranges in which you're changing them and all of the things that you're testing, that you've already done all of the work beforehand to minimize the chances of overfitting so that you can utilize that tactic successfully. Oh, poor Ninja. I have to put you down. It seems to me that in my platform that I want to make, that maybe the backtester should be a different application from the trading system. That they talk to each other and stuff, but like it's a different process, so that if I don't like something about the backtester or it's crashing or something like that, that it doesn't crash the rest of the platform. think we're all good there. A good backtester might actually be the better product. Well, I really think that part of the product is the combination. Because the thing that NinjaTrader doesn't do very well that really bothers me is that I don't really have very good control of my data. They've kind of like, they handle all time data because basically the data broker handles time data for you. And so all they're doing is grabbing data from the broker over to here. So when it comes to other things where you can't get that historical data, you want to save and manage it yourself, there's absolutely no tools to do that. My indicator suite does that for you so that you can do back testing for order flow setups. But, you know, there's some limitations or friction points that you kind of end up with using somebody else's platform. It would be really nice to have a tool that goes in and allows you to change things about like how long I keep data or how I manage it, that like I keep it here for a certain amount of time and then I move it and all that sort of stuff. Right. Then you get into the machine learning stuff and it's like, okay, I want to run a robot, but I also want my robot to be reading the market real time and adjusting itself based on the data that's coming in as well. So you do that, right? Well, you can't really plug into it in NinjaTrader very well unless you're using a C# library, which, I mean, they're out there. I haven't really used them because the platform was not on the latest version of C# and it's only been recent, and then I can't use it in the recent one because the whole thing with Rhythmic. Yeah, it's just all these little things. I think I can make a better platform. NinjaTrader is a really great platform, but I think that we have some insight into it that other people building platforms don't have. But do I actually have the wherewithal to like write it out and do all the work there? I don't know. Do you acknowledge that there can be traders out there trading with an empirical proven edge that you're just not aware of? Of course. Well, I mean, Renaissance technology almost certainly trades with an empirical proven edge that we are not aware of that works on short time frames as well, right? I think that there are a lot of edges out there that we're kind of like generally aware of, but not aware enough of the details of it to duplicate their strategies, right? But there's other issues too, right? Like a large degree of the empirical proven edges that are trading out there that we are not aware of. The reason that we're not aware of them is because we're not doing the work to try and find them because they require very fast execution, and we know that we're not going to have that, right? So but that's where it kind of gets into this spot that's like, okay, I can make a 3D graph here, okay? And I can say this graph right here is time frame. I need a much smaller. Okay. Time frame. data series. So there are strategies that we know happen on midterm. Oh, and this is like number of known strats. Okay. So there are things where you're like momentum, where you're using mid to long time frames, and a large universe of assets. And we know that there's a lot of strategies like that, right? So that's like right here, and then we're going to go up and we're going to draw a point, and then we're going to say this is like over large time frames. So we're going to come up and we're going to draw a data point, right? So there's like, okay. Then there's also ones that we know that the time frame is very small, and the data series, there's a lot of data series. And so we make one like that. So this is HFT. This is momentum. Okay. And we know like generally that there's all these higher time frame things, right? But in between all of that, we're not. And so it kind of goes like this, right? There's some sort of and then again here's one where it's like there's this little blip right here, and then kind of goes like that. Okay. And so there's this little spot in here, this area right here, which is basically the ditch of retail, right? We don't have a massive number of data series. We're not trading super high time frame or super low time frame. And there's just kind of this middle area where it's like, is there any edge there? I don't know. It's conceivable that it's there, but we don't know what it would be or what the trick is to get there. So if this unknown that he's talking about is in that little area, right? I'm just talking about a trader manually putting orders who came across a method that gives him an edge. Okay, so there probably is, but like it's really a question of how many of them, right? So the issue that you get here is like, okay, so we have 1,000 traders. Okay. 80% of those drop out. Okay. So you get 200 that maybe last 5 years. Okay. Of those, there's probably about 70% or so lose. Okay. So that really means that out of that 1,000 people, there's maybe 60 that over a 5-year time period have made money overall. And of those 60, like how many made money every year? Probably not even a quarter of those. So I don't know what the split would be after this, but let's just say, for the sake of argument, that after that, we get 10 people out of that 1,000 that were quote unquote profitable traders. My position or theory is that of those 10, 7 were lucky. That only like 3 of those people that actually make it actually had a real edge. And when you go out to 10 years, only 3 of those people will still be profitable. Okay. And more to the point of your question, where he says, I'm speaking of a trader who noticed when price is above XMA and the chalk and money flow is above X with the MACD setting of X, etc., etc. My other position is that of those 3 with edge, that they are not utilizing price action or some set of indicators or any of this sort of a thing. It's possible. I mean, like, it's possible in that, like, anything is possible, right? Oh, I forgot to turn off my where are you? Bluetooth. Sorry about that. Okay. And that comes back to my other theory. My other theory is no S of X. Let's say no. Should I even write it out? My theory is no strategy exists where the only input for that strategy is a single 1-minute bar of time price series data. That's my theory. The theory. Why? Why do I believe that? Because there's too much noise on that time frame. If you take multiple data series, you can kind of say, okay, this component is coming from this component is coming from this component is coming from this. Everything that's left over is noise. Now that you kind of know where the things are coming from, you can utilize those other data series and then possibly find a potential edge. Okay? But a single time price series, I don't think it exists. It's possible, but I don't think it exists. So, how would we prove that theory wrong? Well, we would have to find a retail trader with a system that is systematized enough that we can view the performance of that system on any data set that we wish, essentially. What I'm trying to tell you is that I've talked to a lot of retail traders. I've talked to a lot of professional traders. And the ones that are having success in the market are not just using a single time price series. That's what I'm trying to tell you. That the big difference, the big thing that I find in strategies that we know work, like more broadly from the literature, or strategies that I have some experience with, or strategies that where I've spoken to people, they all involve some deviation from that 1 minute, a single 1 minute time price series. It's either adding multiple time price series, that's momentum, adding order flow data, that's like HFTs, going to daily bars, things like that, right? That's why I'm saying like it's like this pit. It's like this pit of despair that it's like, yeah, 1 minute, 5 minute single data series, nothing that we know of. But the further away from that you get, the greater the chances are of finding a profitable strategy from it. If that 1 minute chart is nothing more than a 15-minute chart broken down into 15 segments, if set edges done in, say, 30 bar segments, doesn't that act into 2-bar 15-minute chart? I do not understand the point of that. I mean, so there's another theory here that I'm not really pushing all that hard. Is, you know, like I make it really specific, and I say, well, the problem is 1 minute bars, but the problem could be intraday bars. It could be that you just have to go out to daily bars. What time? Well, that's exactly what we're talking about. Is we're saying, okay, like, so I tried drawing a 3D graph, but we're saying we have a graph here of time frame and profitable strats. Known profitable strats. Okay. So here we have 1 second. Okay. 1S, 1M, 5M, 15, 30, 60, 1 day, 1 week, 1 month. Okay. And what we basically have is there are HFTs. And then when you come down into here, it's like, I don't know if they exist. And then do we come up to this gulf where we know that there are like momentum strategies and so forth, right? So I think illegal immigrants' question is there a large set of profitable strategies in this pit that we just haven't discovered yet or are just not well known? It's possible. But what I'm saying is there are some things that we know about the market that kind of make us think that there's a problem with this time frame in general. Like, even quite honestly, if all you're using is price, then these ones kind of don't work either. I really think that you need order flow for these ones to work. And you need scale for these ones to work. You need to be able to, like, trade a large inventory of things, you know? So there's kind of this weird thing where whatever it is that retail traders are trying to do kind of ends up being at the center of where things don't work. What time frame do retail traders want to trade? They want to trade on bars between 1 minute and 60 minutes, and I don't know if there's really any profitable strategies in there. Retail traders want to look at a single asset and make all of their decisions based off of a single data series, and I don't know if there's really if that can really be done. I've never seen that. I've never seen a profitable strategy doing that before. Retail traders want to take single outright positions. I want to take single outright positions. I've never found a firm or anything like that that does that. Like, is there a firm out there that like we just market make treasuries and that's all we do? Or is there somebody out there that's just like, we only trade treasuries, that's all we do, and we just look for these little places where we can make a little bit of money? Like maybe it's high frequency trading, but like they're never have an open position of more than a few contracts at a time. I don't know if that exists, right? And maybe the reason that this is unprofitable is because everybody could do it and everybody's trying to do it, and any edge that was there has already been removed. You get what I'm saying? So you can either keep digging in this ditch further, or you can walk out of the ditch and see if you can find gold outside of the ditch. And I'm kind of sitting over here with one foot over here and 1 foot over here, going like, "Oh, this is fun," right? Oh, okay. I see what you're saying now. Illegal immigrant is no. I think the answer is no. So what you're saying is, okay, a single 1 minute data series doesn't work. Does 1 minute plus 15 minute plus 60 minute work? I tried that, and my conclusion was that it doesn't work. It seems to me that any kind of analysis that you could do with a 60 minute, you can reconstruct the 60 minute with the 1 minute. So all of the there is information in a 1 minute chart that is not present in a 60 minute chart. That's why it's really useful in our theory to say if all you have is a single 1 minute time price series, because then you could expand that out to say, since you have the whole 1 minute time series of the thing, you could change it out to a 1 day bar if you wanted. And so then it would come down to actually just looking at a single 1 day chart of one asset. You can't really predict very well where it's going to go. So really at that point, what is the issue? The issue is this data series. This data, there's a problem, guys. There's a problem with price. That's really the whole point. There's a problem with price, and if all you're trying to do is use price for your trading, you're extremely unlikely to have long-term success. You need more than that. You need to follow the news. You need to follow sentiment. You need to look at order flow. You need to look at other assets and try and sort out where money is coming from and where money is going to, what your currency that you are trading in is doing. All of this data, then you might actually have something. And that's why, and why do I harp on that point? Because I make money from it, right? Because all of these indicators, somebody might say, well, okay, so if all, there's a problem with price, then indicators on price, those aren't going to help out either, right? Well, that's true, but it's a function, not an indicator, because an indicator could bring in another data series, and guess what? That's what my indicators are doing. Inventory cost basis is based on the sign of orders, market orders. That's another piece of information that is not present on your chart that we need level 2 data to do. So we're bringing in other data series and doing analysis on that. Largest resting orders. This is order flow data, right? My indicators bring in additional data series. So they are not the same as your traditional price indicators. Well, there you go. Fatfish says, I guess that might exist, but it would take an exceptionally developed sense of intuition, which would take a ton of experience and heartache, plus it would be unlikely it would be reported. Well, yeah, that's probably true. It would be unlikely it would be reported. But that's a theory, right? The theory is that there is a 1 minute bar. There is a strategy that utilizes only a single 1 minute data series to bring an edge into it, right? And so the question then is, why? Why do you want to believe in that theory or find that? Yeah, you know the stats on trader failure, you'd say a lot of things. Yeah, it's really hard to verify a trader's results. I've never come across somebody that's really given like full 5 years of data and has the data broken down for you. So you think that it is more likely than unlikely, but why? Well, the larger question I'm not asking is why you think it's more likely than unlikely, although I am asking that now. But the larger question that I'm asking is, why is that particular question interest you? Because what I'm trying to get at is that I think that your attention has been intentionally focused by the way that the market works and people that are making money from the market. They've intentionally put your attention in the place where you're least likely to find edge. And so you got to ask yourself, why am I interested in that particular thing? Why was that the thing that appealed to me? Why didn't I, from the get-go, just say, I'm going to be a swing momentum trader? Why did we all say I'm going to scalp instead? What was it about that attracted us? And I would say, well, I think that if I'm trying to trade an informational inefficiency, I kind of think that on like a period of a few minutes to a few hours, that I'm probably able to manage my risk better and trade off of that inefficiency better. That's my argument, right? But that is, I'm not really looking at price whatsoever. So if I do want to trade on those time frames, doesn't it make sense to just not look at price whatsoever? For me, it does. It's probably seeking the affirmation of a quick result in patience, basically. That might be. That might be. Well, I'm disputing your broad claims of no empirically proven edge. Well, but what you're saying is, you are correct. There is no empirically proven edge of that kind. That doesn't mean that it exists. Correct. But that's the whole scientific process, right? Is that in order to prove that that's wrong, you have to find one and prove it empirically. Right? But I'm also saying there's other empirical data that we have that does suggest it doesn't exist. That what we know about the inefficient market and the randomness injected into the market, that on that time frame, the data that you are getting really is truly random, and it is just physically impossible to separate out the signal from the noise without having outside data. Influencers bringing in rubes to provide liquidity. Yeah. If my stream was basically, hey guys, we're swing traders and all we're going to do is momentum, I don't think that it would be a very interesting stream, would it? Because it would basically be like, well, we took a, we've been in this trade for 5 days and yeah, we're down, but it doesn't really matter. Like, this is not a good show. 100%. There is a to a degree that what is a good actual strategy does not necessarily match up with what is fun to watch on YouTube. Otherwise, our stream would probably be a lot more popular. Right. Okay. So now that we've kind of established that, what do you do about it? Well, it depends on what your goals are, right? If your goal is to get away from your day job, stop trading. Go start a small business. That's probably the only way that you're that's going to happen, is by starting your own small business. I don't know what the idea would be. I haven't done that. I would like to do that, but I'm not an expert in that. It's not going to work. Trading's probably not going to bring that to you. Chances of that trading bringing that to you are so infinitesimally small. This is not really worth pursuing if that is your only motivation, because there are so many more easier ways to achieve that than trading. Now, if your goal is that you're interested in the market and you want to understand the market as much as possible, well, then it maybe still makes sense to trade that time frame, because I think that there's some value from being on the front lines and watching the play-by-play and seeing how it goes. You get a good understanding of what's going on, and that doesn't necessarily mean that you'll be able to predict the market or that you'll ever necessarily be profitable, but you're achieving your goal of understanding the market, right? And if your goal is that it's just a hobby and, I would maybe like to make a little bit at the very least, then maybe you should move towards momentum strategies. And if your goal is, I'm a quant, I'm really interested in quant stuff, I really want to make money doing quant stuff in any way possible, but and I want to be as active and as involved in it as possible, you could do the momentum thing, or you could work on HFT strategies. Right? But what we do is really only for the person that really enjoys the market, loves watching the news, loves watching the play-by-play, etc., 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 right? The downside of any bot is that running the same rules regardless of market conditions, true edge would be, for example, a bot for trends and a different bot for ranges. Well, yeah, but that comes back to the time frame thing, right? Like those are kind of problems inherent in when we're holding a trade for 1 minute to 60 minutes or whatever the deal is, right? In a momentum strategy, I'm basically I know that most markets aren't trending. I'm only looking for a situation where a market could be at the beginning of a trend And most of the time it's not, but when it is, I make so much. And that's how a momentum strategy works, right? Or an HFT strategy where I'm providing liquidity and everything. As long as I'm able to account for the probability of informed trading based on the order flow that I've seen, it should be able to work regardless of whether it was a range-bound day or a trend day, although they do tend to make more money when it's relatively volatile but range-bound. Now, but when you do come out to momentum strategies, everything that I've been told from the momentum strategy guys is that you want to have a certain amount of both trend and mean reversion built into your strategy. Yeah. Scalping is definitely not for beginners, and it's hard for me to believe an experienced trader would aspire to be a discretionary scalper. Like more broadly, I don't know very many people that they traded for large organizations and whatnot, and now that they've done that, they want to come out and trade on a 1 minute time frame. Right? Like the people at the institutions all pretty firmly believe that you can't do it. Or rather that you shouldn't do it. Because every edge that they're aware of basically only comes out at scale that retail traders don't have. So, doing the Indian bobble thing. So, how far back have the treasuries come here? To 07. I think I got it at 04.5, and I think it should have been more like 06. It kind of makes me wonder about how much of that really would have been worth trying to hold it. I don't know. But we got in 20 minutes over. So. So not all scenarios trade equal probabilities, and a major way to deal with that is through size? Maybe. But that's another one of those things where I think that we as retail traders might be misinterpreting what professionals have told us. Because for a professional, for a momentum strategy, the actual triggers when I get in and when I get out are really quite they don't really mean a whole lot to the larger performance of the strategy. They go through and they do all of this stuff, and then they can find a different set of entry criteria and find that the other set of entry criteria doesn't necessarily improve things. Where a large degree of their edge comes from is managing the size of the assets in the portfolio. So they're going to look at the volatility of that asset, and they're going to adjust their size based on that volatility. They might look at something like, what is the expected volatility that we're going to get out of it if it really starts to trend? And then they're also going to look at how correlated is this to other things that I'm holding in my portfolio. And the real magic from those strategies comes from doing that kind of analysis and adjusting the size of your positions to give you a result that basically will give you results uncorrelated to the returns of any individual component. Okay, right? And so they'll tell you that it's like the real edge, and it is true, the real edge in these momentum strategies is how you size the trade. Does that really apply to what we're trying to do with an outright trade on short time frames? I don't know if it does. I've tried a bunch of things to try and see if that is, and it all just comes out random. It all just comes out random. Like, does it really matter that you trade larger size on this one? Like, what is the probability? Like the difference in probabilities that we're talking about here are like not even really quantifiable to begin with. And if they are quantifiable, we're maybe talking about, a 5% difference. So I don't know if that actually matters for our type of trading. Yeah, what's your opinion on gamma levels, and are they able to be back tested for mechanical trading? So there's some really good research on gamma levels. There is. They are picking up on a real thing. They theoretically are back tested, but I don't have the data to do it. So kind of like the most straightforward strategy of utilizing these gamma levels, I don't know how that actually performs. Only that we have some empirical evidence about the market and those gamma levels enough to, I think enough to justify retail traders looking at those. And I think that if you are going to trade the S&P 500, that's probably should be a significant part of your strategy. Because it seems like, especially since COVID, that has become a very significant flow. As a struggling momentum trader myself, I completely agree with that last statement about position sizing and risk adjustment. Yeah. I tell you what, like the math that they do with those is really insane, because you're talking about like taking a matrix of like 100 different instruments and looking for cross correlations between them and stuff to find like what is the optimal sizing for each individual element. It's really wild stuff. And you get the machine learning involved and all that stuff. Sizing would, but how? I mean, I don't know. How do you know? Like, again, because we can't quantify it, right? It's just, if you can show me a systematizable strategy that has a win rate of just 60%, it's like, let's go. I'm hoping that we find them once we have enough data here with our order flow, because I do have some setups that like it really seems like it works pretty well. But it's something that's never discussed. Well, we only discussed it because we read a book about momentum, and we had a guy do a podcast with us about momentum. I want to bring a lot more professionals on, but we'll see. I'm having a problem. Like, there's some content that I should be making. I've been having a problem writing it, making it. It's okay. Do you play poker? I should, but I don't think I'm ever going to get into that. Seems like poker would be a place where like I could probably get really good at poker, but it doesn't seem like something that I should let draw me in. It would either matter or it doesn't matter at all. Yeah. I mean, in my back testing, the only thing that like changing the position sizing does is it doesn't, if you have a strategy, a results curve that looks like this, right? Changing your sizing doesn't change the direction of the strategy or anything. It's just, might make them go like this, right? It just will change the slope of the line. Different thing when it's multiple assets. You just started learning and you're playing the bots. Mm-hmm. I would like to get into a competitive-ish thing again, but I'm too burnt out, guys. I'm, like many people, tired of putting a lot of work in and not being rewarded for it. Really tired of it. But I'm also really tired of trying to find a job. Really, just at this point, just want to find a new day job and deal with that first before I go back to like, oh, okay, maybe I would really like to play a new video game that's maybe competitive. The nice thing about something like poker is it'll always be there, and I could just obsessively play poker every day, right? But yeah, priorities. Like the thing is then like I expend my effort, and then when I get to the point where I have the time, I don't have the creative energy to do the things I need to do. You know, like, hey, after all of the kids were home and I don't have to watch the kids while my wife is shuttling people around and stuff, and then I have time where maybe I could write a new video. But probably if I sit down and try and write during that time, probably nothing's going to come out. So I watch Lack again. Hopefully they leave me alone today, because I really want to get further on Rust. I did get a little bit further on Rust yesterday. Where are we at? 40 of 94. So we're almost halfway done. When starting out, I tried so many different risk strategies, all based on arbitrary formula, but the only thing that has reduced my loss is basing risk on expected result on each trade. Well, but that's interesting, because like your expected result, you know, because that kind of sounds to me like what you're doing is you're saying, well, here's this support line, and I think we're going to go up to that. Which, there again, I've never been able to find any kind of evidence that suggests that anything like that works. Everything that I've looked at is that like the only thing that changes like how far I should expect it to go is like what the current volatility is, right? And then and at that point, if I size things based on the current volatility, all that does is narrow the distribution, right? Is like if I have a strategy and it doesn't make money and it goes like this, right? Changing that sizing just means it kind of goes like this, right? Just the width of it is smaller. It's an auction that's kind of... I don't want to get into that one. Go watch my volume profile video. I should really end the stream. Past few days, you guys have gotten really quiet towards the end of the stream, so to be like extending the stream a little bit. But now that it's 9:30 is the latest that I ever want to trade, to be honest with you guys. Curious that we're all the way back down to 60 again. I wouldn't even say it's a two-way auction. I mean, the term auction can be a little bit too broad, right? Because we think of an auction as there's a guy, two people, they want to buy, and price will keep going up until the price is higher than the other guy is willing to accept, right? But that's not what's happening. What's happening is there's a guy out there that needs to buy a lot of something, and he will continue to execute into the market until all of his orders are filled. So in order to predict how far it's going to go, you basically have to know how many contracts he has. Catfish, I'm going to check it out. Thank you. Seth will do all the work and then not take the trade. Well, I'm probably too risk adverse, especially right now, but it's kind of sad because I was gearing up for a time when we were going to take a lot of risk, and then we lost the day job. So one of the things that's been preventing me from taking risk is kids. Like, It's just too much energy. But they've gotten to the point now where like I have to be in the room, but like I can play a game or I can be on the phone. You know. Anyways. But I'm not going to be taking on risk, you know, like because anything that I come in and I lose, that's money that could potentially keep the stream going longer, right? So we don't want to do that. It's okay. I get discouraged, but I think that there's still a really, really good chance that I'm able to find a day job before like my drop dead date. And it's not even a drop dead date. It's just like at that point, I have to like dip into savings and sell things and stuff. I really don't want to do that. But again, part of what I'm trying to tell you is I honestly don't care so much anymore about whether I make money from trading the markets or not. Like I'll show you the results and like it makes money. Like I have some results that a lot of people would be like really shouting from the rooftops with, right? And I'm just kind of like, meh, because it's not that actually that great. It's like slightly profitable. What I care about is what you know about the markets. And so what I'm going to tell you is like ways to actually prove things about the markets and what have we actually proven. I think that what is proven is more likely to lead you to profitability. But we have to acknowledge the possibility that perhaps the edges that are available really can only be carried out at scale or have some other qualities that make them unsuitable for us. And then at that point, really all we can do is just be observers. But then there's this other side of it, which is that as we've learned about the markets, we've discovered things about the markets that have profound implications for the rest of society that they've basically been kind of ignoring or it's been slept on for the last 30 years, essentially. In part because the political implications of it is kind of the political implications of it kind of works against pretty much everybody that's in power, both business leaders and politicians, because they've built their entire system. Everything that our system of power in the Western world is basically centered around this idea that the market is right. And if the market is not, if the market is wrong and horribly informationally inefficient, then we kind of have to change everything about how we make decisions, especially in businesses, don't we? They don't want to hear it. I think that telling people about that is more important than me making money from the market. It seems like if I made money from the market that it would maybe help me tell people that, but I don't know if it's ever going to work that way. There are people that came up with this research that are making tons of money. And the whole thing is they don't have social media accounts. They're not YouTubers. They're not famous people. So my whole thing has kind of been turning into trying to give them the voice, trying to teach you the things that they know that everybody's sleeping on. And that's what we've really come down to. So do watch the videos, because I think there's important stuff in those. How much does human behavior weigh into your philosophy of markets? Well, I definitely am interested in behavioral economics, but for our trading, it does not play into it as much. When we're getting into human behavior, what you kind of have to do, this is where you get into agent-based networks, which is kind of like the new frontier, right? So, well, how are people actually thinking? And when you take all of the different ways that people are thinking and you combine them together, sometimes at scale you will get certain behaviors. Like there's no way you can see it from all of but once you have enough data, you can kind of take a step back and you can see like a very clear behavior, right? If you want to know more about that, read the book Making Sense of Content, Making Sense of Chaos, A Better Economics for a Better World by J. Doyne Farmer, one of the founding members of the Probability Company, which was basically like the first ever quant firm. Really good stuff. And he basically explains all of the issues that we have with our current economics school of thought. Any parts? No, I think you read the whole book, but it's not a trading book. I just warn you, it's an economics book. But it's a book that we want everybody to read. It's a book that we want everybody to read. So, but if you want a book that's like going to help you trading, there's a book that's going to help your trading. Then you want to read Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot, Julius Bernard, Jean-Yves Danier, and Martin Gould. And that's where it was kind of the genesis of all of this empirical information that I share with you. See, my edge here, I don't know if my edge is necessarily a super great trader. It seems to me like I have a reading of the news and what's going on in the markets and stuff like that is above what your typical retail trader is. I don't know why that is. I feel like I'm the only person reading the news. I don't know. I try really hard, but I don't think that I'm anywhere close to like what an elite trader at a desk knows. Nah, but the thing that I think that I'm elite at is seeing the connections between things. I can look at the research that we have about the market microstructure, and I can relate it to what we do here in retail trading in a way that other people can't see, or how it relates to society at large in a way that people don't think about. That's my advantage. And then I just happen to have a YouTube channel because I don't know, it kind of happened that way, and maybe that's what God wanted me to do. And so I have the opportunity to be the one that brings this information to you because of that. Super cool. Really, when you think about it, like really think about that, we are experiencing an economics revolution, a revolution in economic science and thought that is as big as, if not bigger than, the Keynesian revolution. And everybody is sleeping on it. And I am the one guy on YouTube that gets to bring it to you. How insane is that? And then I'm supposed to, you know, when I think about it that way, and it's kind of like, yeah, you know, whether I lost a sim trade yesterday doesn't really matter, does it? What's your favorite part of the Trades, Quotes, and Prices book? Oh, it's definitely the Kyle model. But you really, the book is actually laid out quite well. You want to read it from front to back. But treat it like it's a college course, right? Like, you're not going to understand everything. There's going to be math parts, like do your best to understand the math parts, but like, you know, you don't need to memorize the formulas or anything like that because they do a really good job of telling you the main takeaways at the end of the chapter. But like really study it, because like, it's kind of like, okay, here's this thing, and then, oh, but we don't know this. But then later we found this, and later, and it kind of helps us understand how we came to the understanding that we do. The symbols scare me. It's heavy math. It's heavy math. I can open up to almost any individual page, and there are formulas and stuff. You can see that on the camera there I'm showing you. Yeah, there's a lot of math and deriving these formulas. It's pretty crazy stuff. I think that most retail traders, when they come through and they find the type of math that they have on these things, is really going to blow your mind. That they can be that accurate with it. That like that there's a measurable impact that a large player has on the market, and that they can measure it and estimate it quite accurately, is really a wild result. It reminds me of how I done. I really wish that I had gone further into the math. Like you know, like I was gonna graduate and I was like, it's time for me to get out of the market, all this. And you know what? It turned out well for me, but part of me wants to go back and just from the very beginning say, I want to be a quant, so that I would have all that time to be good at that stuff, you know? Because I feel like it would probably be difficult for me. ADHD is kind of difficult thing to learn, but I think that once I learned it, I think I'd be really good at it. And I would enjoy it. But, Trades by Brandon, that's the new name. What's up? You know what? You came in like right as I'm trying to shut. I've been saying for 45 minutes I'm going to go. I'm just going to go now. Bye. I'll be back tomorrow. It's fine. Stay excellent, team.